Well, inflation has been showing signs of cooling off, but it may be short-lived. Energy prices spiking in recent weeks, with crude now trading at the highest level that we've seen in nearly a year, just below $90 a barrel. We've already heard from airlines warning of higher fuel prices. So the question now is whether this could affect the narrative that the economy is definitely heading for a soft landing. Let's talk about that and more with Mark Zandi, Moody's Analytics chief economist. Mark, it's good to see you. Thanks for joining us.
Thanks for having me.
So here we are with crude prices rising steadily, just shy of $90 a barrel. When we think about this in context to the Fed's fight against inflation, how problematic is this potentially?
It's potentially problematic. I mean, the economy is performing well, growth is slowing, inflation is moderating, everything is consistent with a soft landing. But, you throw in the mix higher oil prices, if they keep going higher and stay higher, that could be a problem. There's nothing, more deleterious to the economy than higher oil, gasoline prices. It slows growth, it sucks purchasing power of consumers, and it adds to inflation expectations. It undermines consumer confidence. There's nothing worse than higher oil prices. So hopefully we don't see oil prices go much above $90 a barrel for any length of time, because that could be problematic.
No question. Oil prices, one of many factors the Fed is watching. We heard from Boston Fed President Susan Collins this morning, talking specifically about the patience that's needed right now, that the Fed needs to keep its optionality still, potential for an additional rate hike. As we talk about what this landing will look like, I mean, where are we in that landing? Forget soft and hard. Where are we in that process right now?
Well, I think we're pretty far along. It's feeling pretty good, right? I mean, we're seeing resilient job growth, but it is slowing to script. The Federal Reserve is working hard to get the job growth down to something that's more consistent with the growth in the labor force, allow the labor market to ease up a little bit. And that's happening. Hiring rates are down. The number of unfilled positions still high, but that's come in. Quit rates are down, compared to where they were a year ago. Layoffs have picked up a little bit, but they're still low. So by that standard, it feels pretty good. The soft landing seems like, is on track. Then, of course, we just talked about inflation, barring higher oil and gasoline prices. I think underlying inflation will continue to moderate and consistent with a soft landing scenario. I don't think we can declare victory, though. I mean, I don't think we can say we've soft landed until it's clear that inflation is back to the Fed's target and the Fed is actually beginning to cut interest rates. That feels like that could be a while, probably this time next year. So all the trend lines look good. Everything feels like it's on track, but still a ways to go here.
Mark, do you still think that 2% inflation target, does that still make sense? Is that still appropriate?
Great question. I think they need to strive for 2%. I mean, they have to keep inflation expectations tethered, because by so doing, they make it easier for us to actually get inflation down. So I think the Federal Reserve needs to continue to state and focus on that 2% target. But, Shauna, once you were in the kind of below 3, in the 2s, I think they can become much more relaxed about, getting it down to that 2% target quickly. Because, at the end of the day, if you were going to pick an inflation target today, given everything you know about the economy and the underlying growth rates, you probably would pick a target inflation rate that's probably closer to 3 than 2. So once we get into the 2s, I think the Federal Reserve becomes much more relaxed about getting it actually down to 2. But in the meantime, they got to stick to that message. They got to keep inflation expectations tethered.
When you look at where things could be going, you've got this report out of Bloomberg talking specifically about the Fed looking to potentially boost growth projections. You look at where the Atlanta Fed is, potentially expanding to 5.6% when you look at growth on an annualized basis. I guess, number one, is that sustainable if that's what we're looking at? And what does this ultimately mean about where the Fed is headed then?
Yeah, I don't think the economy is growing 5.6%. No, I mean, it had a pretty good July, and I think that's what's reflected in these so-called tracking estimates that are based on, all the monthly data that is available at this point in time. But my sense is that once we get the August and September data, we'll see an economy that's still growing somewhere around 2%-ish, kind of close to the economy's potential. And I think that's roughly where the economy is. But here's some good news in that regard in terms of growth and inflation. It does feel like the supply side of the economy is stronger than we thought. If you look at labor force growth, for example, the supply of labor, that's been extraordinarily strong. Labor force participation picked up in August, and the labor force expanded by over 3 million in the past year. That's pretty darn good. And then the other thing that's happening is productivity growth seems to be kicking back into gear. It was quite depressed back a year or two ago, but it feels like it's starting to get some life back. So you get more labor supply, you get some more labor productivity growth. That allows the economy to grow a bit more quickly without generating inflationary pressure. So, I think it still feels like we're in a 2% economy, and I think that's sustainable.
Mark, do you think the strikes at all could potentially change the dynamic that we have currently right now, at least over the last couple of months, is slowing a growth here within the labor market? But we still have the two unions on strike in Hollywood. We have the threat of the UAW strike looming. I guess, what do you see? How do you see that impacting the labor market here over the next several months?
Well, the strike would have to drag on for an extended period, a long period of time, more than a few days, more than a few weeks, probably more like a few months for it really to add up and have a very large impact. And I'm speaking most specifically about the UAW strike. That's probably the most serious threat to the broader economy. But it's small in the grand scheme of things. So it'd have to drag on for a long, long time. I mean, if you're kind of scouring the planet for things to worry about, oil prices are number one. You say second on the list is probably the potential for a government shutdown. The UAW strike, the labor market actions, they're on the list, but kind of towards the bottom of the list.
Mark, how likely do you think a government shutdown will be or is?
Well, I think it's more than likely. I'm hopeful that it will only last a few days, no more than a couple, 3 weeks. I mean, I think the political pressure for Congress to get it together and for them to sign on the dotted line to fund the government are going to intensify pretty quickly. As soon as federal government employees don't get their paycheck, I think there's going to be a lot of political pressure to get it done. So I think pretty good chance we'll see a few days of shutdown, maybe a couple weeks, but I'm hopeful it doesn't extend beyond that. But that could be, if that lasts for very long, that could add up. So just a rule of thumb. For every week the government shuts down, that shaves 0.1% off of annualized GDP growth in the quarter. So if the government shut down on October 1, it didn't reopen until January 1 of next year, that would shave 1.2 percentage points off of fourth quarter growth. And in an economy that's growing 2, that's a lot of growth. So we don't want to see that. I don't think we will, but that gives you context.
Hopefully we don't. All right, Mark, always great to get your perspective. Mark Zandi, Moody's chief economist. Thanks.
Thank you.